Let's discuss Reg A's, or as they're often called, mini IPOs. It's just an exemption under the Securities Act of 1933 from registration, but it's not the same thing as a private placement. Like, it's not subject to Rule 144. So let's give you the basics on it. There's generally two types of Reg A's. They call them Reg A and Reg A Plus, or Tier 1 and Tier 2. The reason it's called the mini IPO is because you can only raise a relatively small amount of money for the securities industry. Might seem like a lot in real life, but for securities, it's not a lot. So there's no such thing, there's no like registration statement or prospectus with a Reg A because it's exempt. But investors still do get what's called an offering circular, which just gives information on the issuer, right? So it's not going to be as detailed as a prospectus, and the issuer still has to file it with the SEC. So let's talk about the specifics, the difference between Tier 1 and Tier 2. So with Tier 1, you can only raise up to $20 million. There's no purchase limitations for investors at all. Those actually exclusively apply to Tier 2. Now, in addition to that, you actually don't even need audited financial statements under Tier 1 unless the states are going to get involved, because they are subject to SEC and state review instead of just being reviewed by the SEC. So you have to deal with what's called blue sky laws, where the USA comes in. That's where, the details, that's like where the C are 63, 65, 66. Now with their Tier 2, you can raise up to $75 million, right? You don't have to deal with blue sky with the states, so you only have to deal with the SEC. The financial statements do have to be audited, and there are certain purchase limitations for investors, right? If investors not accredited, they basically can't buy more than 10% of their net worth or their net income, right? So if they're accredited, that's the whole thing with the 200,000, 300,000, last 2 years expectation to continue, $1 million net worth excluding primary residence, that kind of thing, active 7, 65, 82. There's plenty of other ones, but I just want to briefly touch on it. Then you have these purchase limitations with the greater, basically, of 10% of net worth or net income. So that's kind of the basics on Reg A's. They're just another way to raise money that's exempt from the Securities Act of 33 outside of like a Reg D. And with a Reg D, you can raise an unlimited amount. With the Reg A, it's a little bit easier, so you're subject to limitations. I mean, you could also use a Reg D 504, which is only $10 million, but again, that's kind of even a smaller number. So they're all possibilities. There's a lot of different ways to raise money out there. So, but with Reg Ds, with the 504, you don't have to deal with accredited investors either. So, but you do have to deal with blue sky law. So it's almost like, you have 504s, Reg D 504s that have the $10 million limit. You do have to deal with the states. With the, and then it's kind of exempt from SEC registration. Then you have the Tier 1, Reg A Tier 1, which is, subject to the state and SEC review, has a slightly higher limit of 20. And then you have the Tier 2, which is Reg A Plus, where you only have to deal with the SEC, and now you can raise up to $75 million. Otherwise, you're going to have to be stuck using a Reg D 506B or Reg D 506C. So I hope that makes sense in the context of things. Please like and subscribe and listen for more. Thanks.